Well, thanks everyone. It's just gone to 4:02, so we'll get started. So thanks everyone for joining us today. Today's event is ESG and the sustainable finance, and we're also looking at fintech and data challenges. This is in collaboration with the Future Sustainable Data Alliance. ASIFMA is a member of the Sustainable Data Alliance. My name is Matthew Chan. I look after public policy and regulatory affairs. I also lead sustainable finance advocacy with ASIFMA's Sustainable Finance Working Group, which is comprised of various members across the membership of ASIFMA, including the sell side, banks, asset managers, and service providers. We've been doing a lot around sustainable finance. It's one of the key priorities for ASIFMA. We've been working on things such as taxonomy and standards, climate-related risk management and prudential regulation. We've also been looking at market development, so looking at climate finance, for example, and what are the enablers to scale that market. But most importantly, what we've been doing, and very relevant today, is looking at data and disclosure. On the corporate disclosure side, my colleague Eugenie Shen in her asset management group is looking at product disclosure, corporate disclosure as well as product labeling, whereas we've also been looking at data challenges, and that's part of our contribution to the Future Sustainable Data Alliance, where ASIFMA is leading the Asia stream. So in terms of today's event, Millie, did you want to just forward to the next slide? We will be having some keynotes from 4:00 to 4:20, and then we'll move into our panel discussion. But to provide a little bit of context, this is a follow-up webinar to one that we held in July, where we kicked off the discussion around data challenges related to ESG and sustainable finance. That was where we had IOSCO's Secretary General join us, the EIU, as well as various member participants. Then we wrote an interim report, which is available on our website, looking at some of the data challenges. And what we really wanted to do today is continue that discussion. So we want to understand and narrow in on some of the data challenges. Where are those challenges most felt in terms of different jurisdictions? What asset classes, for example, but also what are the key enablers for solving some of these challenges? And in particular, we wanted to hone in on technology. Both what are some of the technologies and technology platforms that have been built up to look specifically at ESG and sustainable finance challenges around data, but also what are some of the key learnings from other technologies such as fintech. So in terms of today's discussion, please participate by using the Q&A box on your toolbar. I'll try and weave in as many questions as I can from the audience. So we would like this to be as interactive as possible. And also we'll have a voting question later on in the panel for us to hear insights from the audience in terms of some of the challenges. Next slide. So without further ado, I'd like to introduce our first keynote, Mr. Ramesh Subramaniam. He's the Director General of Southeast Asia Regional Department of the Asia Development Bank. And we've asked him to provide a little bit of insight in terms of some of the ADBs, the Asian Development Bank's perspective on sustainable finance, some of the work they've been doing in particular around the UN SDGs, but also some of their viewpoint in terms of scaling sustainable finance in Asia. So I'll hand over to Mr. Subramaniam.
Thanks so much, Matt, for those words of welcome. And thanks so much to ASIFMA for this invitation to ADB. And I'm very delighted to be with you at this very timely conference, which brings together the two critical challenges that we are facing: financing ESG for sustainable development and how to use technology for the economies in the region to leapfrog in doing so. And also we look forward to hearing the perspectives from the excellent panel of speakers that you've assembled today. And once again, thanks so much to ASIFMA. By the way, my colleague Anuj Mehta, who's the coordinator of our Innovation Hub in Southeast Asia, has been working with me, and he'll be taking, as I share with you some perspectives, we will be rolling over a few slides. What I want to do in this time that you've given me, Matthew, is to set out the challenges, lessons, and solutions that we at the ADB have been seeing in this arena from our work across developing Asia and the Pacific. Indeed, ESG for all of us in this call, for many institutions, and to ADB, forms a central tenet of ADB's work and our strategic directions as we've set out for the region in our Strategy 2030. As a barometer of the progress that is being made, if you look at the SDG index scores that you see on the screen now, economies in East, South, and Southeast Asia have progressed the most since 2010 and since the adoption of the SDGs in 2015. But as you can see from the many red dots here, major challenges remain with regard to several of the SDGs. And this is only likely to be made worse due to the COVID-19 pandemic. ADB's assessment indicates a significant negative economic impact across all of Asia Pacific region due to the pandemic, with the economies expected to contract 0.7% this year, the first time in 6 decades. If you look at region that is closer to where we are, Southeast Asia or East Asia, of course, China is an exception to this trend. Southeast Asia, for example, is likely to contract by about 3.8%. These are large numbers, and we are also seeing large-scale revenue contractions as well as expenditure realignments, which are quite important as we look at these two topics today. This will have a major impact on jobs in general, and especially amongst the youth. It will also undo decades of progress that the region has made in poverty alleviation. And as I noted, it will also constrain both public revenues and expenditures, which means less public funds being available to spend on SDG-related investments. Meeting the climate finance challenge was already critical in developing Asia, especially with increasingly polluted air quality in cities and shrinking water bodies. The financing needs to meet climate resilient investments were already massive at $1.7 trillion per annum, with a massive financing gap of about $460 billion per annum. Now, this challenge has just gotten worse now with less public funds being available and more risk perception at the private sector levels that need to be managed. Hence, the requirement now is to stimulate private capital from all sources. That is not just from public-private partnerships, but increasingly the capital markets and institutional investment sources like pension and insurance funds with huge pools of resources. If you look at 30 trillion just in OECD countries, and some projections state that it could be about 60 trillion in global pension funds over the next few years. But getting the needed volumes of bonds and equity issuances and other access to finance mechanisms is a major problem. And amongst the challenges, there are several challenges that we see. The issue of lack of bankable projects and capital markets not yet having been scaled up, they come at the top that the region needs to manage. Now, green is the way forward to meeting many of these challenges. It's going to be a cross-cutting theme across most of the sustainable development goals. It is easier to target and well understood by both governments and investors. Now, that's not to say that there are not going to be challenges. There are going to be significant challenges, but let me share with you some perspectives here. And in Asia, green finance was already growing pre-COVID-19. If you look at in 2019, for instance, it was at $47 billion in green bonds alone. That is in the Asia Pacific, which is a record high. Now, this is clearly an area with significant potential for development, as Asia, with the exception of a few countries, still accounts for a relatively small part of the global green and sustainability bonds market. Now, green finance through the capital markets will bring in both capital needed for SDGs or broadly sustainable investments, but it'll also bring in the rigor, the discipline, and the scrutiny that are so vital to ensuring SDG and ESG compliance by various entities as well as the projects that they'll be financing. Now, if you zoom in on Southeast Asia or ASEAN in particular, We at the ADB have already been seeing major interest in green recovery through capital markets. Just in the last 3 months, we are working with 2 countries in the ASEAN region to support the development of green sustainability and even transition bonds. We provided support most recently to Thailand for the issuance of the Thailand Sustainability Bond, the first by a sovereign in the region and perhaps the first such bond post-COVID-19. With very clear green and social projects, the bond raised almost $1 billion and was over 3 times oversubscribed, showing significant investor interest. The social bond in Thailand has also successfully generated a lot of interest and is again one of the first such bonds by a state-owned entity in Asia. Both of these, we believe, will have clear replication potentials, my apologies, from both issuances. Now, in scaling up such efforts, whether in capital markets or in other green finance approaches, multilaterals like the ADB have to play a major role in supporting governments build their green recovery strategies. Now, we've already made our vision clear with an intended target of $80 billion in climate finance investments by 2030, and support the green and sustainability bonds in Thailand, as I mentioned, is a critical element of this support. Now, quite recently, on the 7th of October, we launched our Green Finance Recovery, a major publication. Now, this, as you see on the screen, it outlines several approaches, including green bonds, but also green securitization, etc., to try and accelerate the agenda for ESG, SDGs, and green investing. Now, we are working on several of these ideas in our countries. A specific example in Indonesia, for instance, is the Sustainable Development Goals Indonesia 1 facility. Now, the last few minutes, Matthew, let me focus a little bit on fintech and digitization. I'm sure the panel will be picking up a lot more on this. Now, this is a critical area for Asia and a way of reaching the large rural and often poor population and deliver to them the SDG benefits. Now, digital innovation, last week, just coincidentally, we organized a large symposium where governments, established tech giants, and a large number of startups joined. There were 5 key policy areas that came out in that dialogue, which can support developing economies as they return to a path of sustainable growth with fintech at the heart of that challenge. The potential for application of digitization, as we all know, is limitless. Now, besides improving access to finance and supporting the urgent social protection needs, or if we look at EdTech, education technology, areas such as digital connectivity, e-commerce platforms broadly, but also e-public governance systems and electronic cargo tracking are vital in spreading out equitable growth from cities to rural areas, while also decongesting cities and mitigating the climate impacts. Now, to support all of these, we've established quite recently a new platform called the ADB Ventures to support and invest in startups offering impactful technology solutions that contribute to the achievement of the SDGs in the Asia and Pacific. In all our work, we collaborate very closely with a wide range of stakeholders, including industry leaders, private sector participants, and investors. With best wishes to ASIFMA for organizing this event. We look forward to working very closely with all of you. In the material, Matthew, that we've circulated, there is a lot more information on digitization and what is being done in the region, as well as what, from Asian Development Bank's point of view, we are doing. With that, let me thank you once again, Matthew.
Thank you very much, Director General. It's much appreciated. Some obviously very key themes and an excellent way to start off the conversation with a bit of scene setting, but also to get your valuable insights in terms of where the region has been evolving around green finance, where it's going, particularly in relation to governments looking to stage economic recoveries, and obviously the themes around digitization or digitalization and the role of fintech, but also very interested in some of your comments around the need and some of the activities around grants, because they're some of the key themes that we want to pursue in the panel. What are the enablers to ensure that technology can support sustainable finance? I'll now hand over, so thank you very much. I'll now hand over to Julia Walker. She is the Head of Government and Industry Affairs for Refinitiv, and she's also one of the lead people getting the Future of Sustainable Data Alliance off the ground, working with different industry partners. But importantly, she's also the author of a book, very relevant, Sustainable Development Goals, Harnessing Business to Achieve the Sustainable Development Goals through Finance, Technology and Legal Law Reform. And she's also a member of the UN Task Force for digital financing of the SDGs. Julia, I'll hand over to you.
Hi, Matt. Thanks for having me here today. And Ramesh, what an amazing presentation that was. And I'm always delighted to see the work that ADB are doing. It's always phenomenal that, you know, the key climate bank of Asia. So I'm going to kick off today to talk a bit more about the international response to sustainability and climate change, some of the drivers, and I'm going to touch on the data and what's happening in the fintech and digital ecosystem. So Millie, can you move the slides forward? Thanks. So just to blow it up a bit broader, as most of us will know, we are in the middle of a climate emergency. And a number of countries have stated that they are in a climate crisis. We've got 31 countries so far that have announced that, 1,813 local governments, and climbing every day. The graphs at the bottom you can see there shows how quickly it's starting to move. And I think that's starting to explain what's happening in this sector. Perhaps a year and a half ago, a lot of you would have been reflecting saying, well, this wasn't a key topic, but it certainly is today, and it's not going away. There's also currently over 1,800 climate laws and policies, and that will continue to grow. So when you have these type of announcements, we've just seen one from China, we've just seen one from Japan in terms of being carbon neutral by 2060 and 2050 respectively. There will be more policy coming through. What we're also starting to see is a lot more focus on areas beyond E. So climate, carbon, a key focus. However, what COVID has also brought forward is biodiversity and a lot of social aspects. It's on the biodiversity front, there's a reflection that, you know, has some of this biodiversity loss contributed to perhaps the pandemic that we're in. So it's a lot more focus there. Now, central banks around the world have really unanimously saying that climate risk is a financial risk. And when that starts to happen, they start looking at the data. So how do you govern? And then when they're looking at that, they've started saying there's a lot of data gaps. With that, there's a lot more focus. And so what we've seen recently is the NGFS and IOSCO launching data sort of work streams and working groups, really looking at harmonizing some of the data issues across Asia and also across the world. What you're also starting to see is alliances, a lot more alliances, a lot more task force. As Matt mentioned, we are a part of the Future of Sustainable Data Alliance, which is actually looking more out to 2030, going what data will we need there, and hence the focus is a lot more on spatial finance, geospatial data, sort of biodiversity, some really complex and hard pieces. But we need to also understand how some of the steps to get there. There's also the rise of all the taxonomies, quite a big shift. Europe and China lead, but there's a huge amount of development across Asia in this area too. So moving to the next slide, I just wanted to touch on some of the key sort of notable ESG developments that are happening to set the scene on data. Because often the conversation is, well, if the standard said it's, you know, we're clearer, it would be easier. Now, I think those arguments are going to go away, and I'm sure the panelists will speak to it in more detail. But I just wanted to set the scene because the last 5 months have been extraordinary. There's a lot going on, and even in October, there seems to be just a raft of announcements coming out. So just wanted to raise some notable ones. So back in June, the US SEC's committee recommended updating a lot of corporate reporting guidelines to include non-financial data. So it's going to be interesting if we get, I guess, a Biden win out of the election. There's been quite a lot of work happening in the US to actually progress the climate focus, you know, if it goes in that direction. In August, we also saw the CFA Society come out with a consultation on reporting and ESG disclosure standards for investment products. That consultation will, you know, sort of will end shortly, and there's some really interesting proposals there. Then in September, you had the 5 standard setters getting together and collaborating. You know, perhaps a year ago that was definitely not on the table, but it's quite a big step in going, actually, how do we align? And I think in Asia in particular, it's been a bit tricky where you have a lot of investors pushing SASB and they've been reporting on GRI, nobody really knows what to do. So there's been quite a lot of progress there, I think, in starting to harmonize. We also saw in September, the World Economic Forum and the International Business Council come out with a white paper that's starting to harmonize some of those standards. They are proposing 21 core metrics that sort of anyone could disclose, with 34 extended metrics all aligned to the SDGs. And that's been run by as I said, the IBC, but also the 4 major consulting firms have been involved. It's been spearheaded by Barclays, so a lot of industry support there. This month, we've seen the IFRS launching a consultation on the future of corporate reporting, and a whole raft of other activities that I've listed there sort of on the right. You know, MAS here in Singapore, you know, is really pushing forward this year. They've outlined the next step from the Green Finance Action Plan and announced a Green Finance Centre. You know, their ambitions are becoming clearer and clearer. And also the G30 has now called for FIs to conduct climate change stress tests across all those countries. So moving on to the next slide, I wanted to highlight also just a report that we recently published with OMFIF, which is a central bank think tank. So we wanted to really understand what are all the central banks doing, because, you know, depending on where they're landing, you know, policy regulation follows. So this report, you're welcome to all, you know, read it and download it. The role of data of sustainable investment policy and regulation. So it's really starting to get a feel about what are policymakers thinking around the world. And in Asia, we interviewed the JFSA, Hong Kong Exchange, MAS, APRA, Bank Negara, Malaysia, all on what they're looking at doing. And the results are really interesting. So the key thing is that they're all really focusing on this. So it is a central banking mandate. It is a threat to financial stability, and they want to understand it. But we need more data. And we need more forward-looking data. And in many cases, we need cross-border data, which was actually raised by the JFSA in Japan. So how do we get to that granular data? And I think these are some of the challenges that we might be discussing today. There is absolute alignment on the need for clear, consistent ESG data. And so it's great to see that all those sort of standard setters are pushing on the disclosure side, but there's going to be a lot more that needs to happen. There's also a great acknowledgement that we need to go beyond disclosures. So even if we do solve the disclosure element, there'll be a lot on climate analytics as needed. There's a lot of alternate data, and there will be need for quite a bit of information coming from geospatial data to give us more timely and forward-looking data. Lastly, what did come out is that biodiversity and nature are definitely the next frontier. We thought that that might be parked a bit, but it's definitely actually more heavily on the agenda than we actually thought there would be. So there is more focus on that. I think some regulators were trying to get through carbon and climate first, but due to COVID, there's actually more progress happening in that space. So perhaps the panelists can touch on that one today. So lastly, I wanted to touch on some of the work that we've been doing with the UN. So next slide, Millie, on the UN Task Force of Digital Financing of the SDGs. And very pleased to hear some of the work that Ramesh and ADB are doing in this space. But I wanted to call out a few key things because I think it's very important for the ecosystem here. One of the things is to fuel innovation. So what is this about? Well, this report and this task force, we've been together for about 1.5 years. It was really looking at digitization and advancing citizen-centric financing. How do you connect citizens back to finance? Have we been decoupled for it? Do we really understand where our money goes? So I think that's a big thing, particularly for Asia. Why can't I invest directly in gender equality or climate action? How can we align a bit more to what we want to see in the world? But the 3 key things that were called out here is looking at catalytic opportunities. One, how can you use domestic savings and putting them into more domestic investments? There's a lot around building transparency and accountability in public finance. Here in Asia, we've been, I think India's been a great example of the India stack and the sort of data platforms and digital finance platforms that they've been building in the last couple of years. How do you integrate the SDGs more into the capital markets? something that we're starting to see is in the data front, and this is one of the objectives of the Alliance, how do you actually start looking at SDG impact and opportunity opposed to just sort of ESG risk? So I think there's a major upside that most people are starting to look at now. On the sustainable sort of digital ecosystem side, there's a great acknowledgement that digital ID, eKYC is imperative. So how do we sort of get these baseline building blocks, which has been a big focus in the fintech and regtech scene, to be able to enable more frictionless payments, to have more financial inclusion? And so how do we get that digital infrastructure right? So I think sometimes when we think of sustainable finance, we don't think about sort of inclusive finance or fintech. So this is why the discussion is so important today. Also, I'll just touch on the inclusive international governance piece. So this is where, what is the role of Libra? What is the role of cryptocurrencies? How would you govern a new monetary system? So some really big, interesting pieces there. If we can unlock that, could we unlock more citizen-centric financing? Could we have more assets that we can share? It's a really interesting piece, and a lot of that innovation is coming from Asia. So stay tuned there. The other one is, how do we govern digitally? One of the initiatives that we took forward was called the Digital Governance of Infrastructure Initiative, which was trying to provide complete transparency to every project finance deal in the world, and seeing sort of who are the buyers, who's financing it, what's the risks associated with that, what are the ESG metrics on top of that. And we've started to partner with some players, WWF on one account, to see if we could actually layer over sort of biodiversity data or World Heritage Site data onto some of these pieces. So from a project financing point of view, we can give more insights to clients, etc. So I'll stop there and hand over to Matt, but I look forward to a great discussion, and I welcome the expert panels to take it away next. Thanks, Matt.
Thanks very much, Julia. Obviously, you've been doing a lot of thinking and contributing to some of these important themes and topics, so very much appreciate you providing that overview. I hope you can stick around, because we do have questions and answers. So if people want to either direct a question to our friends and colleagues at the ADB or indeed to Julia, we'll try and squeeze some of those questions in either in the panel discussion itself or at the end. So Julia, hopefully you can stay around and answer some difficult questions that you might get. All right, well, let's move on to the panel. So we're very excited today to present such a great panel. My guests are Gabriel Wilson-Otto. He's the Global Head of Sustainability Research at BNP Paribas Asset Management. So thanks very much, Gabe, for joining. Cameron Khan from Deutsche Bank. He's the Asia Pacific ESG Head for the bank. Eugene Goyen joins us from EY. He's the Asia Pacific Financial Services Regulatory Lead, but has also held previous positions as a regulator himself at the SFC in Hong Kong. Helene Lee, founder of Go Impact, and secondly, General Manager of the Fintech Association of Hong Kong. So welcome, Helene. And finally, but certainly not least, Helena Fung. She's the Head of Sustainable Investment for Asia Pacific at FTSE Russell, and she's also the co-chair of ASIFMA's Sustainable Finance Working Group. So welcome, everyone. Thanks very much for being with us today. As you know, we're very keen to unpack some of these topics and issues and get a little bit of an understanding around ESG data and technology in particular. But perhaps Helena Fung from FTSE Russell, I might cross to you first. I wonder whether you could help us by setting the scene, so perhaps providing a bit of an overview in terms of ESG data, what it's used for, and what are the main use cases in relation to sustainable finance and ESG.
Sure, thanks, Matt, and thank you for the invitation to join the panel this afternoon. And I think I would start by maybe reiterating what the keynote speakers said, and in particular, I mean, Julia's point that really, all of the great initiatives that are happening at the moment around sustainable finance, around tackling some of the major issues like climate change, all really rest on access and availability of data, and not just, I guess, the scale of it, but also the quality of it. So I think, when we're talking about data, it's really, these are the inputs that power a lot of the a lot of the activity that's going to really bring some significant change. But I think in terms of use cases, probably the use case that most people will be familiar with for ESG data is really as a starting point, as an input to the investment process, and as a basis for portfolio construction or an input into that, and into investment decisions. So I think using ESG data to really sort of understand the broad range of ESG related risks and opportunities that companies are exposed to in their operations is probably the element that has been most helpful in terms of scaling up focus in this area and incentivizing companies to want to produce more data. And we talked a little bit in the keynotes around company disclosed information versus other data sources, and it'll be really interesting to unpack some of that in this discussion. But I think this is really also very relevant for Asia, where we do see a lot of companies being very exposed to a range of ESG risk, whether that's from biodiversity, whether related to sort of social or human rights issues, or from severe weather-related events, as we're deriving from climate change. So I think starting with risk management has really been a very key motivator for ESG data integration. But I think there's also a lot of focus on the ability of ESG data to really unlock information on companies that could be relevant to driving returns and really the opportunity set around ESG. So I think this is another very important use, again, very relevant to Asia, where there's a great focus on the possibility of ESG to create alpha. But the other point that I think is very interesting to make here around the use of ESG data is that I think as regulators and governments, and particularly in APAC, are looking to build capacity and to scale up the role of financial institutions in being very instrumental in helping to mitigate the dangers of climate change, with climate really emerging as a very key ESG risk. We're seeing ESG data used in a variety of different ways, and I just cite some of those. So within credit analysis, and we now have a number of cases, I think it's becoming relatively commonplace that ESG scores and ESG data is being taken into account in determining lending rates, for example, and in assessing the risk of insured assets and in scenario analysis and banks and in bank stress testing. And the other point to make, I guess, is around asset classes. So, I think ESG integration has really sort of begun with equities or with corporate issuers, but when investors are looking at other issuer types, private companies, for example, sovereign issuers, then you get into a whole range of questions around what kind of information is material in this context. And then just as a final point, I would say also measuring outcomes. I mean, the two keynote speakers talked about the SDGs and about having impact. And I think ESG information is really helpful in sort of measuring the outcomes of some of the integration and in the way that investments and finance is being oriented towards more sustainable outcomes.
Thanks, Helena. That's a very useful start for us and a great overview of both the uses of data, but also some of the challenges that you're seeing. Let's perhaps unpack some of that. We did start this discussion, as I said earlier on, in terms of the first webinar that we had. We started to unpack them in our interim report. Some of the findings, for example, were around the source of data. So we found, for example, that 48% of institutions are using third-party data, 50-50 between in-house data and third-party data. And then obviously the rest is a mix of third-party ratings and also other types. And in terms of the challenges, we found that 56% of respondents in our last survey around the previous webinar found that inconsistent data was an issue. So this is, I guess, touches upon comparability and standardization. And then 35% mentioned poor quality of data as well. Cameron, I'll turn to you first from Deutsche Bank. Cameron, I'd be interested to hear your take on what you see as some of the challenges around the use of the ESG data. Oh, Cameron, you might be on mute.
Okay, great, I'm back. So I think it might be helpful early on in the discussion to actually have a discussion around the definition of ESG data. So when we say ESG data, what are we talking about? And I think there's some important considerations there. When this market was in exclusionary mode, where you were talking about do no harm. At that point, I think the data that is currently available from the marketplace was relatively adequate. So as an investor, you could say, well, I only want to invest in these types of companies, and the data set could actually, very easily exclude the ones that you didn't want to look at. And then after that, you could make the decision on financial metric and so on and so forth. But now that we're looking at how do we do more good, not necessarily just avoid doing harm, and you're talking about a forward-leaning, proactive, creative side of the market, the data that is currently available in the marketplace, I would say in many ways is quite inadequate to make a good ESG investment decision. You can make a decision on publicly available data, on publicly available names that you're investing in, and that is largely related to their rating and maybe one or two layers below on what the ratings are based on. But if you really wanted to ask whether the impact will happen and whether there's a data set, there's an entire results framework in place that actually shows you the logic between money and impact and attribution, I think you will be looking for a very long time. So it's okay to use basic principles that everybody else is using to make your ESG investments. But I think as the market moves towards more specificity and more detail and more inquiry around where's the impact and how is your investment attributing towards it. And that is particularly going to be the case in Asia Pacific, where economies have gone through significant economic development over the last couple of decades. So people here actually know what ESG problems look like. And I think the questions are going to be much more detailed. So that brings us to private data, basically. So this is not going to be publicly available stuff. Even for a public name, a public company, when they do an actual transaction and they say, we're going to use X amount of this for our project or our operations in Y country to produce Z impact. Well, that information, I think if you were just relying upon the company on its own, under its corporate framework, disclosing that, you are not going to get very good quality information about that. And no data source that you're relying upon is going to have that. Second question there is the data sources that we are using now. It's not clear to me they have the expertise to actually understand on the ground issues. For that, you have to have people like Ramesh and, who have done hundreds of sustainability projects in their life to be able to actually understand what is good quality data on impact and what is just a general description of where the company is. And so that's the second thing. And then the third, and I'll stop with that, really the key driver for improving the quality has got to be disclosure. So if there are disclosure requirements around financial instruments or around corporate governance from the regulators that go into significant detail or sufficient detail, then companies will have to make that data available and be held accountable for that level of project level data. Otherwise, it is going to be pretty much reliance upon third parties that are really relying upon companies volunteering data about not only their corporate operations, but even on specific projects. And if that's the case, I see the market moving more towards project bonds, project ESG bonds, where there would be clear speculation, indication within the offering memorandum about what data will be provided, at what regularity, and so on. So I'll stop there.
Thanks very much, Cameron. That was a great overview, particularly, I guess, the root cause analysis that you're almost doing, which is to kind of go back and see what some of the issues are, including going back to disclosure. I'd be interested, Gabe, from your perspective. We've heard from Deutsche Bank, Cameron. We've also now got the opportunity to speak to you from the buy side. I know you've got some thoughts. It'd be interesting to see whether you have a different perspective. I also know around climate change, you've been looking at some of these issues, and in particular, Scope 1 and Scope 2 emissions reporting. I'd be interested in your thoughts around some of those issues. How much is estimated? Are there issues around consistency of reporting? But even more generally, what are some of the challenges that you see from an asset management point of view?
Sure, cheers, thanks Matt. I think that if we're looking at ESG data, as has been highlighted by the other speakers, we really have to be careful about what we're actually trying to measure and the objective that we're trying to reach. And so we can have an impact focus. We can also have a risk mitigation focus. We can have an opportunity to actually try and drive incremental revenue, or it can be a purpose for actually just meeting a regulatory requirement. So there are a lot of different potential use cases that come into play for ESG data. And we find different pain points within different pockets of these sort of areas. But as Cameron was highlighting, quality and consistency of disclosure is one of the key issues that really underpins a lot of these challenges. And where this comes down to is that if we look at financial metrics, the availability of standard P&L metrics across companies in a portfolio is pretty consistent depending on business model type. So you've always got the data to evaluate the companies that you need to do some analysis on. If we then turn to ESG, if we're looking at something as widespread as climate change or carbon emissions, the actual data availability starts to dry up really quickly, and especially if you want to go and do historical analysis. So if you'd like to do some back testing or to look at what happened 5-10 years ago, the data just falls off a cliff and you're left with a sample size of 10 companies, for example, to look at. So it challenges the ability to do a lot of analysis and more impactful and insightful work about looking at a snapshot of where companies currently sit and how that's trended over time. So going back to carbon emissions, and to address one of the points you raised there, is that actually most of the data points that are available are estimated. And so this is not a company reported data set. It's actually a triangulation based on industry characteristics, company size, potentially energy mix, or a few other factors. And so this can get you a ballpark number, but it depends on what you're trying to do. Are you trying to have an estimate of what a portfolio's impact is and portfolio's footprint is? Or are you trying to benchmark two companies to actually determine which one of them has the better engagement with climate change and the better track record of moderating and mitigating some of these risks that might arise? And so again, coming back to the first point, depending on what you're trying to do and what you're trying to measure, different levels of accuracy and availability can start playing into these problems. The other big topic is around scope of reporting. And so often the scope that a company is reporting under is not consistent with their financial accounts. And this introduces a heap of problems around measurement. So in order to compare two companies, you need to normalize the data. So you typically try and remove size by using revenue or assets. If someone's emissions or water or pick a metric isn't reported on the same basis as their financial data you're using to normalize it, you end with a completely nonsensical result at the end of the process. So there's a lot of these types of problems around quality, consistency, availability, and then also fit for purpose that starts arising very quickly when we dig into a lot of these topics.
Thanks, Gabe. That's very useful insights. And it's particularly interesting given at some points we often consider climate finance being one of the more advanced areas around ESG. There's many targets with the greening of the financial system, etc. And yet we are still faced with some of these challenges. So it's probably a good opportunity or a good space for us to be concentrating on from an industry point of view to get things right around climate. Let's turn to Helene Lee from Go Impact. I know you've been working with private investors, I guess from a data point of view, looking at different options in terms of where to invest. Maybe you could shed some light in terms of what some of the data challenges are around that.
Sure, Matt. Thank you so much and really delighted to be here. I think I spent a good part of my career in private banking before I founded Go Impact as a platform. And I'm hearing this loud and clear that investors, private investors, family offices in particular, the shift has been happening that ESG is no longer an alternative or a satellite in their portfolio. They would very much like to shift that to the core, the center stage of their portfolio. And yet, what's available out there in the whole investment universe, apart from ETFs, et cetera, and other passive investments, they really are keen to move more ESG integration into their portfolio. And that is very difficult to do unless you have reliable, trackable data, consistency of benchmarking, and so on. So I really echo the keynote speakers, Julia and Ramesh, and also what Cameron and Gabriel has been saying before, that there need to be a lot more investment grade data in order for investors to be mobilized. So you have all these tailwind from regulators for higher disclosure, for more transparency. But for that to translate into mobilizing private capital, you do need the data gap to be plugged along the way.
Thanks, Elaine. Well, that's been a great synopsis, I guess. We've gone from the asset or the investor, the asset manager, and we've also had the insights from Cameron from the bank's perspective. Eugene, let me turn to you. Still trying to unpack the challenges that you see and the group sees around the use of data. We've obviously started to pick into the details. Obviously, there's different uses of data. There's different contexts. So that we need to be mindful of that. Maybe you could provide some insights from an EY perspective and your personal perspective in some of these issues.
Sure. Well, look, it's certainly not the easiest issue to solve. And I think one of the reasons for that is we're still at a nascent stage of evolution in ESG, whether it's the environmental, the social, the governance, or simply the climate change, which is probably the most acute focus at the moment. As with any nascent area of human endeavor, standards converge over time. And I don't mean to be complacent in saying that, but if one were to think of light bulb standards back in the late 19th century, human endeavor in and of itself provides a dynamic towards convergence through innovation and the diminishment of standards and data sets that do not provide utility to an end use that's productive. However, having said that, I think, there are multiple dimensions at work here that will drive the refinement and the making of data to be more utilizable effectively. So it is decisionable, to use an ugly word. And they're of multiple strands. Some are market disciplines. Some will be regulatorily driven. Some will be driven through collaboration, and some will be driven just through native innovation. So I've dealt with what I would regard as the native innovation and the application of human ingenuity to this. I think the next thing is, let's just think about market dynamics. Now, inevitably, the mobilization of capital and the desire and demand for, companies and other entities, product issuers, investors themselves expressing their preferences will to some degree derive a demand for, which will provoke innovation to drive a more developed and usable set of data and metrics around this. Now, that's not a panacea. And again, I'm not trying to be complacent, but with demand comes satisfaction of that demand effectively. However, there is a bit of a chicken and an egg situation here. Is the data gap inhibiting the mobilization of those market forces that would drive that innovation? Or is it, a sort of consequence of nascent demand and generation here? I think so. There's a chicken and egg dilemma here that I don't think any of us as yet are in a position to solve. So we have to work on both equilibrium, basically. So there has to be market innovation, which will come with time as the asset management industry is pivoting towards making ESG a centerpiece of their asset allocation strategies and investment strategies, as retail and other investors and family offices at higher levels, etc., sovereign wealth funds, etc., start mobilizing their asset allocation strategies towards companies and other investment opportunities that demonstrate ESG characteristics, this will drive a need for issuers, product issuers, corporate reporters to produce that data. Now, having said that, as I say, you know, the quality, the variability, the opaque methodology, the quantitative style of a lot of the issues that are required to be examined for ESG, the application of environmental science to, you know, a financial methodology and an investment methodology, which are not the most easy bedfellows, but they will converge to be some degree of intertwining, mean that there are some hurdles that need to be overcome. So this will come about through, I think, firstly, you know, some degree of a regulatory standard setting. Now, we see that at the international standard setting level where, you know, entities like IOSCO are more active in this area, where previously they've stood back and left it to a body of what I'd call quasi-private collaborative initiatives, which have led to a proliferation of standards, which probably isn't that helpful. And with standard setting bodies such as IOSCO intervening more heavily into this area in the future, you will see, you know, some of these initiatives and some of these plethora of standards be tossed aside as, again, there's regulatory pressure to converge on a reduced number of standards, a reduced number of data points, and there will be clear, you know, articulated standards set for what data must be disclosed, how it must be disclosed, and that will provide some ostensible pressure on issuers, product issuers, corporate reporting agents to produce usable data that the industry can work upon. Lastly, I think, you know, this is an area where governments and regulators have to, you know, band together with industry and also academia to collaborate, to pool their knowledge, because this is an unusual confluence of two very complicated disciplines. Finance is a complicated discipline. Environmental, social, demographic, geographic, and other disciplines are phenomenally complicated as well. You know, this is not an easy environment in which to expect perfection so rapidly. I think the problem is effectively is that the clock is ticking, the environment is deteriorating. With environmental deterioration will come greater social deterioration, which will also impose problems for the quality of governance, because there'll be stresses, both environmental and social, upon those quality of governances, and that provokes somewhat of a vicious spiral downwards, potentially, in the worst scenarios. And I wonder if the global community, including the finance and the regulatory community, are really, although they're very active, they do not move with the greatest pace, I think, particularly international standard setting bodies. If one thinks about the global financial crisis, a purely financial one back in 2008, which had far less dimensions of complexity than the ones presently facing humanity. They still haven't finished off the set of financial reforms that were meant to resolve that some 10 years later. Here we find, a global crisis of environmental, social, and other dimensions, including financial eventually. And there's a sort of very round and round the garden, like a teddy bear approach to resolving it, I would say. Certainly there's a greater pressure and velocity to action, but I still personally, this is not an EY perspective, I still personally wonder if we're moving at the haste that we need to be moving at. Now, none of these are easy problems to resolve. I think what I've tried to do is illustrate the complexity of it, but it needs action on all of these fronts to be resolved effectively, I would say.
Thank you, Jean. And we will have a poll question later on, asking one of the questions you raised earlier on about, do we just need to set up the sustainable finance market, scale that and see whether innovation will just follow in its own in its own way, or does it need to be encouraged? So we'll unpack that a little bit later. But I'd be interested to perhaps turn to Cameron and Gabe. Eugene actually mentioned some of the stakeholders and some of the players. I guess one question that we have is, who should be in the driver's seat for pushing some of these changes? Is it the industry? Is it data providers? Is it the regulators? Do we leave it to the corporates themselves, investors, or organisations representing them? Cameron, perhaps I could turn to you in terms of who do you think the key players are in terms of driving some of these solutions?
Thanks. I think a useful way to think about this question, which is, I think, a very important question, is to think about when an ESG transaction actually happens. So somebody invests in something that is ESG aligned or ESG compliant or what have you. That investor is effectively buying one product with two components. One would be the economics. So if it's a fixed income, the coupon rate, or if you're making a private investment, there's some IRR expectations and so on and so forth. That's your economics. And then you're buying impact, because your board or your funders, your stakeholders have clearly come together and said, we want to either do this because it is good for our business, it is the most resilient investment approach, or it's good for our commercial viability, it's whatever their motives are, right? And they could be PR related motives, or they could be very commercial business related motives, and so on and so forth. They are expecting, when you make an investment like this, your stakeholders, however you define them, they're expecting you to have two components. So they want you to be able to say, okay, if we allocated $5 billion out of 100 billion to ESG, how many tons of CO2 are we removing with these $5 billion? Or if you say social impact, then you say, okay, how many lives are we touching? If you say you're increasing salaries, okay, how many people and what percentage of increase, and how are we going to know this on a regular basis to know whether this impact is on track and whether it's just a 3-month gimmick or if it's something real, right? So that's basically what we are solving for. You want the market to make triple bottom line decisions. Well, it is willing to make those decisions, but does it have the information available to assess different opportunities and make the right decisions? So to me, fundamentally, this has to drive from two sources. One would be regulation in terms of, right now we as a society, we say, if you're going to invest through capital markets or private markets, that the investor has to provide information so you can make those decisions, either as a trade association subject or a government regulation subject, or from a market perspective, you say, we will only deal with people who provide data consistently. So we do that right now for purely financial investments. There's no reason to think why something like that should not be in place for impact as well, for ESG investment. So it'll have to either come from either the market, just like a bunch of investors started this movement by saying, not in my name, I will not allow my money to be used in activities that I do not feel comfortable with. And that's how this ESG market started. I think at some point, the ESG market can also say, we're not going to invest in ESG instruments that do not provide data and do not promise or demonstrate that they have a full-on results framework monitoring system in place that will provide reliable data going forward. That is the fundamental drivers. Now, in between, you could have third parties. data providers, data assessors, all of those people are there, but I don't think they are going to change the trajectory of data quality. It's only the first two primary drivers that probably stand the best chance of changing that trajectory.
Thanks, Cameron. Gabe, I'd be interested to get your perspective. Obviously, you've talked about different use cases. I might also throw in a question that we've had from the audience, and it's around asset managers, I guess, being perceived as still viewing ESG as purely a strategy to generate returns, not so much the improvement of society. How can we change this perception? So I'd be interested to understand your thoughts. I mean, are these two things mutually exclusive? Are they not? But also your thoughts in terms of who should be in the driver's seat in terms of the changes needed to solve some of these challenges.
Sure. I'll target the second one first and deal with the question on driver's seat, and then jump back to the question from the audience. So if we're looking at the people that are best placed, or the entities that are best placed to drive change or address some of these challenges, I think it really needs to be a collaborative approach. And the reason I'm saying this is that I think that there are a lot of different use cases or pockets of the market that you can move through specific initiatives. But in order to see broader based change, we need to target a lot of different areas. And so, for example, here, if we say we won't, as an investor, we're not going to invest in companies for a green bond strategy or a specific fund unless they have data at a specific level, which is similar to some of Cameron's comments around an investor or issuer or fund owner led movement. That will impact some assets and some issuers, but not necessarily the entire market. Because there might be people who don't want to tap that type of finance or choose alternative styles of financing. If we look at then the consistency of those requirements, that single approach may not ensure it. And so it may be required to look at it from a regulator perspective, a standard setting body, in order to help drive consistency around ask and definitions. Another channel that I've seen be incredibly effective about the volume of information, that you can make arguments around quality of information, has been mandatory disclosure requirements in Asia, which has really moved the dial significantly on volume of information that's available. I'd argue that this is an important first step in getting corporate engagement with the topics, and we can now shift towards more strategic engagement with the data and higher and better quality governance structures around data release and engagement with information. So again, I think that if we're looking at asset owners as setting objectives and providing demand for the data and rewarding companies that do, standard setting entities in terms of coming up with a unified set of templates, guidelines, taxonomies that everyone can follow, and then regulators being supportive of this to try and broaden the diffusion of the disclosure amongst other markets and to provide guidelines on what is required. I think that all of these elements acting in concert can drive real change. And this is tied into the second question, which is why I wanted to address that one first, is that in my experience, the asset management industry is very, very good at doing what its clients tell them to. So one of the reasons we've seen a huge explosion in the number of ESG products and ESG sustainable assets under management globally in the last 5 years is because the demand for it has gone through the roof. And so I think that the increased demand for these products will naturally see more of a transition towards more thematic and social impact funds that are being developed. The other side of it is that I think that the market is increasingly recognizing, and this goes to some of Cameron's comments around mainstreaming of ESG and shifting away from an SRI version into a fundamental way of doing business approach to ESG, which is that there is overlap in certain situations, not in all cases, that there can be significant overlap between doing good and doing well. And this is definitely what we believe at BNP Paribas Asset Management and how we run and manage our funds, which is completely integrating ESG into our fundamental approaches in all of our products. So we believe that you can have that type of alignment, but I think it's going to be driven by both the mainstreaming of ESG and more association with risk mitigation and opportunity identification for fundamental assets, as well as more funds which have a specific objective of driving impact, potentially even at the expense of returns.
Thanks, Gabe. Helena Fung, let's start to dig into the technology piece. So I know you touched upon some of this before, but let's really try and get into an understanding from your perspective around some of the, or an overview of some of the new technologies being used to address ESG related data challenges. And I'd also be interested to get some insight in terms of, you know, some of these solutions or problems Asia Pacific specific.
Sure, thanks, Matt. So I think actually Gabe put it very well when he talked about some of the regulatory initiatives within APAC, not to mention globally in terms of you know, scaling up corporate disclosure on ESG issues, and there being a vast difference between the amount of information that comes out versus the quality. So I think really, you know, there's some great activity here within Asia on a regulatory front, for example, incorporating TCFD into reporting guidelines, which will help to drive some of the information that investors need. But, you know, at the moment, I think there's a recognition that in APAC there are data gaps that can be usefully filled by technology. The other interesting point that I think is Asia specific, of course, and I think Julia touched on this in her keynote, is the shift towards digital and fintech in Asia, which is, I think, very prevalent in this part of the world, and the potential for some of these technologies to mitigate the relative paucity of standardized, consistent, and comparable data. But in terms of technology, and I'll talk a little bit about what we're doing versus, I guess, where we see the potential for technology to make a difference. You know, and again, going back to Asia Pacific, I mean, here within Asia, the markets are very integrated into global supply chains, and companies face issues around climate change and biodiversity, but we don't necessarily have all of the information that investors would like to have. And there is therefore a great potential for technology, I think, to help to bridge the information wall. So looking at something like sub-country asset-based data, for example. So here technology, I think, can really help in terms of getting to know what companies are actually doing, where they're located, and what the risks are that they face. So getting some very deep data that companies don't disclose about their operations. And I think just to mention directly a few of the technologies that can be really impactful here. So the use of NLP and alternative data sources, I think, has the ability to help investors to really probe beyond corporate filings and company disclosed information. An example of this might be, you know, there are companies like Miotech or Red Pulse in China who are probing government records using NLP to see where companies have been fined for pollution or perhaps you know, censored for certain activities like discrimination or breaching cybersecurity laws. But I think the focus really as well is on very sophisticated modeling techniques at the moment, and on creating much more forward-looking data. So to give you an example of this, we bought a company, a French company last year called Beyond Ratings, which is classified as a fintech because it has very sophisticated models that analyze and map where companies and sovereign issuers are against various emissions trajectories and scenarios, and also how much effort is required to then reach the goals of the Paris Agreement. So it takes a very forward-looking and predictive approach to the data. So at the moment, I think a lot of this is really about how you use alternative sources of data as opposed to disclosure, and really how you model that to create something which is quite powerful in terms of understanding what the outcomes might be. I mean, another way that we're potentially using some of these more sophisticated modeling techniques is really around looking at REITs, understanding at a building level what the carbon intensity is, what the energy usage is, you know, looking really into very granular data sources, you know, understanding the level of heating that's required by knowing the temperatures around the buildings, electricity bills, occupancy rates. So aggregating and modeling all of this data, I think are ways that there are ways that we're using, I would say, technology internally. But I think there's also maybe a more aspirational use of some of this, some of the technology. And if we look more in a more forward-looking way, I mean, I think around the physical risk of climate change, which is very hard to extrapolate. And there are around 50 different models for estimating physical risk, looking at geospatial data, heat mapping, and so on. I think has a very interesting potential for investors. So companies like RS Metrics, which is a very typical but a very interesting fintech, is demonstrating the potential use of satellite images for tracking plants and factories around the world on a monthly, even on a weekly basis. So this sort of data has the potential, I think, for incredible insights into where companies are active, what they're producing. They can even analyze, looking at sort of carbon concentration around individual sites and geomapping the risk. So I think there are some very interesting uses here. But the only thing I would say to this is that, it's great to have AI and NLP to call and retrieve data. I mean, from our perspective, we're an index provider. We're rating and ranking and benchmarking thousands of companies. So it's really important to see beyond kind of the noise and what you can retrieve, and look at what's actually going to be material and what's going to be useful. And the other thing, of course, that's important is to know what's missing. So if you have data, say, on 30% of the sites, then you need to know what you don't have. And I think possibly if you're looking on a case-by-case basis, it's easier to incorporate some of this terrific information into your analysis. But it's still very important to go back to sort of having consistency, comparability, transparency, and very strong governance around the data that you use. So, I think there's great potential on the modeling front. There's lots that we're doing already, but I think, it will be really interesting to see how some of these technologies develop from a user perspective.
Thanks for that. I had to look up NLP, natural language processing, and that was a theme. So AI, which is related to that, was one of the themes that came through from our earlier discussion. But that was a great overview in terms of all the dimensions of this. And another theme that came through in our last discussion and in our report is around the challenges around backwards-looking data and how do you make decisions about a forward-looking horizon. And so presumably that's where some of these modelling technologies might come into play. I'll turn to Helene Lee from the Hong Kong Fintech Association. I'd be interested in your thoughts on some of these challenges and some of the things that Helena mentioned, but also just more broadly. So Helena was talking specifically around some of the data challenges, but I'd be interested more generally about how technology and fintech is supporting ESG and sustainable finance.
Sure, Matt. I want to pick on 2 points that I think was so well put by Gabriel and also by Helena just now. Gabriel mentioned that what do the finance industry or asset management industry respond to the most? The demands from their clients, right, from the asset owners. And we are hearing loud and clear asset owners wanted this to be center stage in their portfolio. Now, we also hear from Helena about some of the Chinese fintechs that have been worked using AI and NLP to process the vast amount of data in order to make some sense of it and to make investors have a more palatable, reliable, and comparable set of information to make investment decisions on. I'd like to, pick on that because I think it's actually probably moving a little bit faster than we like to think. I know Eugene mentioned that we need to all pick up pace on that. I think there are various fintechs that are operating and working really hard in terms of the data analytics. So if you have all the NLPs and the problem with data is it's so fragmented that is impossible to make head and tail of it. But the whole data analytics thing, benchmarking, the public data, data that you actually generate from news, hopefully not fake news, and other sources, alternative data. I think that is a huge data analytics tool beyond just AI and NLP that I think there are various fintechs that are working together on. And I think that is very much needed. And going back to Gabriel's earlier point about how do we actually address the integration of that into the portfolio, I think the shift also happens with more predictive, forward-looking analytics, that there can be more progress being made in the active space apart from the passive investments asset classes.
Thank you. Eugene, what are your thoughts? What are your thoughts in terms of technology, I know you touched on some of that earlier, but just generally technology supporting sustainable finance?
Well, look, it is a necessary tool, but it's not a panacea, because I think at the end of the day, it's the decision making and understanding what decisions that need to be made that is critical. But obviously, data is the biggest problem in ESG. It's sort of a garbage in, garbage out sort of analogy, not to be rude. But I think a recent Economist article, which is probably the most high level but intelligent outsider assessment of sustainable finance, recently said that, you know, it's data that's inhibiting ESG effectively, and the quality of data, the consistency of data, you know, all the problems that the other panel members have touched upon quite intelligently. Look, I think there's multiple roles for technology here. You know, Helena referred to geospatial data to supplement the corporate reporting that corporate issuers are making increasingly under listing rule frameworks that require them to report data. That's even more critical for the unlisted corporate sector that have really very little, close to no reporting obligations in this area that would be usable for financial analysis and for direction of capital towards them. I think there are issues as to the forward-looking tools and the model engines here that are critical for producing that forward-making data, relying a lot on big data techniques. And that requires an issue that I should have touched upon earlier, which was really governments making data available and open access for you know, ESG systems to work upon effectively, and particularly technology systems to work upon. I think then you have the issue of the auditability and the tracking of various issues for which blockchain, which, you know, I think was much hyped when it first came out, but its prime applicability is for a very publicly visible and difficult to defraud audit trail system effectively. So that for tracking, you know, supply chain issues and other issues, carbon footprint issues, carbon trading issues, that's sort of quite useful, I think. Thinking further, there's sentiment analysis, which some of our fellow panel members have referred to in terms of using natural language processing to identify, you know, social and governance issues relating to companies to supplement their own disclosed data under listing rule and other reporting regimes. That can also assist with, you know, environmental compliance in various aspects. So that's useful, I think. And probably lastly, there's other machine learning and AI techniques that go towards compliance with sustainable development goals. So there's a number of different dimensions. I wouldn't say that's probably definitive of all of the use cases. And as I speak, somebody innovative and clever somewhere is developing more use cases. Are we at the forefront of this in Asia? Well, you know, Fintech has been let off the chain in Asia, I would say. Are we the most innovative geography in the world? I would say that would be hubristic. Certainly, China takes an interesting attitude to financial and tech innovation. Obviously, they're placing great stress on two issues. One, the environmental sustainability of what will be the world's biggest economy if it isn't already, which will have an enormous environmental footprint, not only for their own population, but globally. And we live in a global commons effectively. I think China is aware of that, not that I wish to overly hype what they are doing. The other thing is the investment in AI that's going on in China, where they clearly do see it as a tech and probably national strength differentiator for them. And there will be some geopolitical rivalry between the West and China in relation to that, that will also spur innovation. But what's interesting, I think, about fintech evolution in China is, to a degree, the financial regulators stepped back in China, which is unusual. Usually they're very hands-on and a little bit paranoid about how issues of systemic risk and other matters are run, regards to banking, regards to shadow banking, with regards to the stock market. But when it came to financial innovation in technology, they said, let rip, effectively. I mean, that I'm paraphrasing, but you know, they've started to intervene in the crypto scene and other areas where they see, you know, unacceptable risk mounting. But basically, they stood back and went, "Go ahead and innovate." So, you know, China has the industrial and technological scale and the intellectual scale, given the number of university graduates they produce every year, to possibly excel in this area. I wouldn't overhype that, but I think it is something that can't be ignored. So, you know, outside of that, you know, if any jurisdiction in Asia claims to be an intellectual leader in this area, I think it would be temporary. We're still too early in this sort of industrial revolution to really say that anybody will hold a material and sustainable lead. You know, the more places that are innovating and competing, the better, I would say. That's not only for that jurisdiction, but for the rest of the world, effectively.
Thanks, Eugene. It's interesting that you mentioned China, because obviously last month, President Xi announced China's target around net zero carbon emissions by 2060. And in the last few days, there's been an announcement about a 5-agency collaborative approach to scaling climate finance. You actually touched upon, and I might throw this to everyone in the group, around jurisdictions. Before we move on, I am interested just to unpack some of the challenges to see whether there's any thoughts or insights in terms of, are there specific data challenges in certain markets, in certain geographies, in relation to certain impact factors, or in terms of asset classes or financial instruments or investment choices? Are there, if we were to kind of hone in on where these data challenges are and perhaps where we should be focusing, does anyone have any thoughts on what priority areas we might be wanting to focus on, or where the issues are the greatest?
I can jump in with some quick comments here. Not sure it's going to be too comprehensive though. I think that there's an element of common problems that are faced across the region. And these are all the ones that we've been discussing around data availability, consistency, transparency, comparability. And I don't think that any one country has a monopoly on those challenges with regards to their data. I think it's actually more of a global problem that we all face. Within that, though, there are differences in level of disclosure. And what we've found is that if we look at the level of data that's available from different countries, there are differences around availability and the ability to assess companies. The other challenge that different countries face regarding ESG analysis or evaluation is the problem of both state ownership and conglomeration, which can occur at different levels in different countries. And because a lot of ESG issues are subject specific or industry specific, if you're looking at a company score, but they're in 4 different industries, how do you come up with the right weighting, division, or assessment of that company? And so typically what happens is they get thrown into a too hard basket with a general list of metrics that associate to general business, and you lose that specific ability to dive into the operations of a company and to figure out their operations. And so there are different countries across the region with different approaches to this. And if we look at some random statistics on these topics, the MSCI ACWI, about half of the companies are controlled by a family or the state, which is, if you compare to the S&P 500, it's 2%. So again, you've got different issues with corporate governance, the proper way of assessing it, and again, related party transactions and other sorts of issues which are more prevalent in some markets versus others. And so again, just to finally come back to the one other interesting point here of a country-specific factor is building on one of Eugene's comments, which is the government data and the ability to access government data. And I know Helena mentioned Meotech and RedPulse previously, but from my perspective, one thing that they're doing really well is getting access to a lot of the information that is publicly available, but in formats that are not very easy to access and not very easy to compile. And so in essentially building transparency and enhancing transparency around data that a company might not have released themselves, but which they're required to report to a government agency as part of a local environmental law or some other law. So I think that different countries can have different pros and cons in terms of the structural way data is made available, as well as some of the challenges that they face.
Matt, can I provide a perspective from the corporate side on this?
Sure.
If there's somebody else with a comment, I can wait. I don't know who's taking their...
No, go ahead. Go ahead, Cameron.
So one of the things that we also have to be cognizant of is that as corporates, companies, as they pivot towards sustainability, they're also, coming up with a lot of question marks. So if I say I'm adopting this sustainable practice, what data do I need to collect, and how should I present it to make a case for myself as a sustainable business, right? And that's another way of coming at this data challenge, which is to provide some clarity on, if you're targeting the S side or the E side of ESG. Now, we haven't even begun to think about how to handle the G side beyond just board composition and so on. But I would like to think that G has a lot more to, there's a lot more to G than just board composition and corporate governance, but especially when you talk about public-private partnerships. But going back to the corporates, I think it's also important to see what guidance can be provided to companies in different sectors and different verticals. And I think that work has started. In almost all the verticals, there are some not-for-profits, trade associations, a variety of different non-competitive players who are starting to provide standardized metric for what is good, what is acceptable, and what is clearly not acceptable. So that's a positive sign.
Thank you. Look, let's go to a poll question. We're running a little bit over time, and we're probably going to go just another 12 minutes or so. Let's put up the poll question, Millie, if we can. I'd be interested to get some thoughts from the audience around what is needed most to scale ESG and sustainable finance enabling technologies. So the first answer is there's no intervention. Market forces are enough to drive innovation required, which I mentioned before. The second one is about interventions and by government on a cash-based basis, so cash-based interventions such as grants or incentives. The third one is around interventions that are non-cash, so policy and regulation. And then the fourth one is industry-driven efforts and market structure. So we're interested to see what is most needed. So what would you prioritize first? I'll let that go for a little bit longer. While we're waiting to see the answer for that, I'd be interested to hear from Helena and Helene around what other sectors, such as insurance, that we could learn from in terms of applying technologies to some of these issues that we're being focused on. Maybe I'll start with you, Helena.
Sure. Okay. I mean, I think it's worth mentioning that the insurance sector is really among one of those industries that's going to be and is already being very hard hit by the effects of the impact of climate change. So the cost of weather-related natural disasters to the insurance industry is around about $150 billion a year. So insurance companies really face a sort of a double risk. There's the risk of underwriting claims deriving from the increased frequency of weather events. And then there's also the risk of a disorderly transition to a low carbon economy, which will impact potentially the value of many of the assets that insurance companies are invested in. So they have the exposure both on the underwriting side, but also on the asset management side. And I think that on the underwriting side, there's some really interesting activity that's worth flagging around how insurance companies are assessing some of the physical risks to which they're exposed, whether it's using, for example, the Internet of Things type technology to really understand the intensity or the growing intensity of weather-related risk. or drone imagery and AI and machine learning. So advanced analytics, I think, is something that will be very helpful to the insurance industry in this respect. And I think we already see that the insurance companies are taking advantage of some of these newer technologies. But it's also then interesting to look on the asset side and see how, well, firstly, I guess the activity of insurance asset managers in perpetuating ESG investing. And I think that's, again, we come back to Asia, it's particularly true in this region where a lot of the asset owners, for example, in China, who have signed up to the PRI from the insurance industry, and Ping An, I would mention here as being really interesting. So they have an AI-driven ESG platform, which I think is based on sort of AI and machine learning, and really using a range of different data inputs to power their collection process. So, you know, I think there are things here that the insurance industry is doing and is using around assessing risk, but interesting also to see how that is potentially being leveraged on the asset management side as well. So I think, yeah, and within an Asian context, I think there's a lot of sort of interesting learnings that can be derived from some of this.
Elaine Lee, what are your thoughts? You putting your Fintech Association hat on, what are some of the learnings you think there are?
I want to just add to what Helena was saying on the insurance sector. I want to highlight two different sectors that I think are in the midst of an urgency to leverage tech to innovate. One is the property sector, and the other one being supply chain. I think with the whole need for energy efficiency and cleaner energy adoption, there's a need for property conglomerates to really look at ways to either retrofit their older buildings or to have SaaS kind of platforms to try and enhance the energy efficiency of buildings, and to adopt sort of like LEED standards, for instance, in the newer developments that they are doing. So we do see quite a bit of that in the property sector, and hopefully all that is following also a bit of the tailwind for more disclosure around their sustainability reporting. We see the stock exchanges everywhere really demanding. The supply chain sector, I think, is a very interesting one. For a long time, they are like, heavily, criticized for, not being energy efficient, the carbon emission, that's being driven through all that. And I think COVID has exposed quite a few cracks in the whole global supply chain system. And I think a lot of the satellite data, as well as a lot of the energy transition, tools, I think people are adopting that quite rapidly. There has been a lot of efforts, I think, being made by logistics companies, as well as big supply chain players into this. And I think fintech or tech, in particular SaaS solutions, definitely have a role to play in that.
Thank you. Look, we're getting to the final stretch. That's been very helpful and a good discussion today. And I think we've really started to unpack some of these issues. Obviously, we could spend 2 hours on this further. Let's share the results of this the poll, and let's start, I guess, wrapping up in terms of talking about what some of the interventions that could be pursued should be. I'm just having a poll result error. Let's see if we can clear this. Look, I don't know if it's sharing or not, but basically the forerunner is policy and regulation to support innovation at 51%. At one point during the polling, I think industry-driven efforts and market structures was leading, but then that dropped back. So we had a late surge from perhaps some regulators that are on the line. Maybe I'll turn to the group as we do wrap up. Thoughts or comments in terms of, well, what are the key enablers? So obviously it's going to be a mix of things. We've talked about collaboration, different actors. I'd be really interested to get some thoughts from the group generally about, what are the key things that need to happen over the next, say, 2 years? Maybe I'll start with you, Gabe.
Yes, thanks, Matt. I think that I would agree with the poll results in that a combination of industry initiatives as well as regulation and policy support are really vital here. And one of the things that I think I would definitely not want to see is fragmentation of standards. And so we've seen some work from SASB, GRI and others pushing towards greater collaboration. We've seen IFRS talking about coming up with global sustainability standards. So a lot of the direction of travel looks like it's in the right direction. And another interesting one was China's Green Bond and Green Industry Catalogue highlighting convergence towards EU standards on some specific topics. So again, it looks like there is a lot of focus globally around coming up with one answer to the problem and not 100 answers to the problem. So I think that that level of ongoing collaboration between industry groups and standard setters is absolutely critical in order to ensure that we're moving in the right direction. And then I also think that the regulators can play a really important role here in driving change and adopting consistent standards across different regions. And when I think about this, I always need to clarify that when I talk about consistency, I'm talking about metrics, not necessarily thresholds. So if we have a common language about assessing performance using the same metrics, there can be a threshold on that metric that is appropriate for Europe, and there can be a threshold on the metric which is appropriate for Asia. And that doesn't mean that you need one answer for the entire world, but in terms of a threshold and output, but it means that we all use the same language. And so we can compare where different regions and geographies sit on a consistent basis. So that would be my 2 cents worth on the topic.
Cameron Khan from Deutsche Bank, your 2 cents?
Yeah, my 2 cents, somewhat controversial, but I would say what's going to really spark a fire under this whole quality of ESG data would be a reckoning of some of the outstanding issues, ESG paper out there, and a review to see how much of that is actually resulting in on-the-ground impact. I think that will spark some questions and some queries about which data are we relying upon and how do we do ESG investment properly. The question I have is who will do such an inquiry, because all the players involved have the wrong incentives. So if you are the investor who's holding that paper, you have already been representing to your boards and your stakeholders that you have this perfect ESG exposure, and then you have to admit that actually no, you don't. You have okay economics, but you really haven't achieved the impact that you've been reporting that you're contributing towards. And of course, the issuer who issued the paper is not incentivized to go back and report that they are actually not achieving the impact that they have promised the investors. So the road does lead to some sort of regulatory or industry-based standardization that requires people to do that. But I do absolutely believe that some things have to blow up before this market gets cleaner.
Thank you. Look, we've got 1 minute to go. We'll have to wrap up there, I'm afraid. On that somewhat sober note from Cameron, let's leave it there. Thank you very much to both our keynotes as well as our panel guests for today's discussion. Very fruitful. We will have a recording of this available on our website. We will also see whether we can share Julia's slides. I think she said that we can, and we'll also endeavour to share the slides from ADB. And then as we proceed with this track, we will also look to update our interim report, because we think it's great to have a discussion here today, but really we need to write down on paper what some of the challenges are and really get into the detail so that we can work with the Future of Sustainable Data Alliance and the industry to make some of these fundamental changes. I'll wrap it up there. Thanks everyone for their time. Thanks also to our audience for tuning in. Very much appreciated and hopefully of value to you. Thanks very much.
Thank you again for joining us today. We'll be sharing the recording of today's session by email in a couple of days. Our next virtual event will be on Tuesday, November 17th, Vietnam IBOR transition. Please reserve your seat by either scanning this QR code on the screen or visiting our website www.asifma.org/events. We hope to see you there. Have a great evening. Thank you.